A real estate investor cautions that despite the 30-year fixed mortgage rate perhaps decreasing for the first time in a month, the market is still preparing for a perfect storm for customers, particularly single and multifamily homeowners. Patrick Carroll, the founder and CEO of Carroll, remarked on Mornings with Maria on Tuesday that we're witnessing a supply-demand imbalance. There's less cheap housing available for persons who desire to relocate to these places, and now they have a lack of buyers because of mortgage rates, Carroll mentioned. So again, this has all kinds of been a perfect storm for the multifamily business. Many people are speculating about whether a housing bubble is about to form, as more evidence points to the housing market being on an upward trend. And will there be a market collapse, or at least a deflation anytime soon? If you want to understand more about experts' predictions related to the housing market, this video is for you. Do you think a housing bubble is coming? In a blog post published on March 29, the Federal Reserve Bank of Dallas found indicators of a brewing U.S. housing bubble. According to the report, even though the rapid rise in home prices by itself does not connote a bubble, there are other important elements to take into account, such as changes in disposable income, the cost of credit and access to it, supply shortages, and rising labor and raw construction input costs are just a few economic explanations for prolonged real house price advantages. The Dallas Fed research stated that when there's a widespread belief that today's robust price increases will continue, the housing market becomes unhinged from these realities. If several purchasers hold this opinion, sales motivated by a fear of missing out may increase prices and raise hopes for significant increases in home values. Despite the fact that the authors of the research referred to the present housing market as abnormal, they came to the conclusion that there is no expectation that repercussions from a housing correction would be equivalent to the 2007-2009 crisis in terms of its severity. Why the housing market will probably remain sizzling. Think again if you were looking for a significant slump to find a property at a lower price. For a number of factors, most real estate professionals anticipate that the market will continue to be robust for some time. Here's why. Gen Z and millennial housing demand is escalating. With 166 million Americans, or half the country's population, who are either millennial-aged or younger as of July 2019, there are plenty of prospective purchasers. This is crucial since, according to the data from the National Association of Realtors, first-time homebuyers account for the highest percentage, 31%, of those who buy houses. Since the buyer population is large and the majority of first-time buyers are under 40, there's still a high likelihood that demand will stay high, particularly given the historically low level of home supply. According to Polina Ryshakov, Senior Director of Research and Head Economist at Sunday, a real estate market for distressed houses, there won't be a slowdown, since there hasn't been much growth in house inventory over the last 10 years. Gen Z will hit 30 in just a few seasons, and will be better financially prepared towards becoming homeowners than millennials were at their age. This indicates that while supply will continue to lag behind demand, housing demand will be at least as strong. The supply cannot fully satisfy the demand. In addition to helping to drive demand and increasing property prices, the extremely limited supply is another factor supporting housing experts' predictions that the market will continue to be robust for many years to come. The main cause of the sharp rise in housing prices, according to Rick Sharga, Executive Vice President of Reality Track, is the mismatch between supply and demand. Additionally, it will require homeowners at minimum a few years to add sufficient new supply to stabilize the market after not producing nearly enough housing during the previous 10 years. The fact that new house development increased in February at the quickest annual rate since 2006, 6.8%, is encouraging. However, it is doubtful that the commencement of roughly 1.8 million new dwellings will have an impact on property prices. According to Odeda Kushi, Deputy Chief Economist of First American Financial Corp., it will take time to eliminate the housing stock debt we have accrued. And even if housing prices slow down from their peak rate of rise in 2021, the imbalance will keep pushing them up. Less people are defaulting on their mortgages. After there have been lessons learned and new laws implemented since the 2008 housing meltdown, one distinction between the housing markets of today and before are that lending criteria are now more stringent. In essence, this suggests that mortgage applicants are now less likely to default than those who applied during the pre-crisis lending era. Before the housing meltdown, it was normal practice for lenders to issue so-called no-doc loans, which did not require applicants to produce proof of their income. Additionally, many government-backed loans have a set of criteria, such as a minimum credit score and down payment. Additionally, authorities also demand that lenders, among other requirements, confirm a borrower's capacity to pay back the loan. Red flags that housing market may become inflated. What many commentators have previously referred to as a strengthening economy has begun to show signs of a recession. Last year, as inflation began to creep up and consumer prices began to jump, alarm bells started to ring. The Federal Reserve increased its federal funds rate in May, the largest Fed rate increase in 22 years, in reaction to the increase in inflation, signaling the possibility of a downturn. Long-term mortgage rates are not primarily impacted by the federal funds rate, but short-term rates, such as those on credit cards and adjustable-rate mortgages, ARMs. Slower consumer spending might result from greater interest rates. The economy won't benefit from Russia's war in Ukraine. Energy costs that were obviously rising are under further upward pressure now that Russian oil has been banned by the United States and the Eurozone as a result of its invasion of Ukraine. Increasing energy costs will fuel inflation's fires even more, and combined with higher loan rates, this might lead to consumers cutting down on their expenditures. This implies that people may become less interested in buying a property. According to the most recent Consumer Sentiment Index from the University of Michigan, consumer confidence fell to a 10-year low in March. When compared to March of last year, the index dropped by 30% to 59.4. According to the study, survey participants were concerned about rising inflation, sharp increases in oil prices, and how Russia's invasion of Ukraine may affect the U.S. economy. The Russian oil embargo by the United States may have a domino effect that causes supply chain challenges and raises prices even further. Consumers frequently feel less at ease making significant expenditures, like buying a house, when prices rise. According to Selma Hepp, deputy chief economist at CoreLogic, geopolitical issues seem to be the wild card and the one that might have significant implications on inflation, which is likely to endure longer than first thought. The Federal Reserve is anticipated to begin discontinuing its accommodative prices as a reaction, particularly raising interest rates. Further weakening might result from a rapid rise in interest rates, especially if they jump in the housing market. What home buyers need to do. Today's market presents challenging options to prospective homeowners. Buyers will likely face difficult housing conditions for the near future, as expectations show that housing prices will remain on the rise and new home supply will tend to fall behind. For some purchasers, this entails leaving large cities in favor of more cheap metro areas. Others will have to compromise on space or other luxuries or extend their wallet. There are, however, purchasers who are ready to take a chance and waive crucial conditions, like house inspection, in order to improve their bid. If the home turns out to have significant issues that the seller fails to identify and address during the inspection, this may wind up charging them more in the long run. On the other hand, if housing prices and equity insist on continuing to climb, buying a house now could result in financial savings in the future, even if it means foregoing other investments. They could also be able to save money by purchasing a property and securing a rate before interest rates and home prices rise. The contrary may also be valid, especially if the economy enters a recession, when there's a danger that the housing market may be negatively impacted by a combination of tight supply and rising inflation. If home values abruptly fall, purchasers may be forced to stay in their homes until the market recovers, or sell and lose millions if they have underwater mortgages. Although this situation is deemed rare by housing specialists, it should nevertheless be taken into consideration. This is relevant when purchasers are forced into bidding wars, or even end up paying more than the home's assessed value. While there are situations where this strategy is appropriate, it's important to seriously consider if the property, neighborhood, and amount of time you want to invest are worthwhile in the long term.